term life insurance versus whole life insurance versus index universal life insurance. Everybody always asks, which one is right for me? Well, there are different examples and scenarios in which you would choose one of these different life insurance that's going to protect you and your family. Adrian, let them know why and when term insurance would be best fit for a family.
Well, first off, what I'll say is I feel like every life insurance is the best insurance because they all play their part of what they're exactly supposed to do, right? Now, term, I think is heavily slept on in my opinion, right? So I'll give you a couple examples of clients that I've dealt with. So I have clients who just want a 30-year term, so something that's long enough to cover the mortgage. Something happens that their loved ones are not going to be homeless, right? Other people have told me like, hey, in 30 years, my kids are going to be 35, 40 years old. I would like to think they have their life figured out by then. Plus, the reason why I say it's slept on is you can get a substantial amount of death benefit for a much more cost-effective price. So yeah, everything's great, but these are some examples of when term may come into play.
Yeah, because even you'll hear sometimes people, they'll look up statistics on Google and they'll even see, only 2% of term policies ever paid out. Well, that's kind of the point. The reason why is because it's only there for just in case you die during that 30 years, you have a lot of liabilities that you want to turn into assets. The way you turn liabilities into assets is you leave a tax-free death benefit to your family so they can then take that death benefit, pay off all the liabilities, and now they own assets where they don't need life insurance anymore. So it doesn't matter if it has an expiration date on it. It's just good for when it's there. Does that make sense?
Makes perfect sense.
Now, Another thing we want to look at in terms of life insurance is whole life insurance. Now, all of you have probably heard on social media, TikTok, Instagram, all these different social media platforms when it comes to whole life insurance, there's a guaranteed compounding interest rate, usually between either 2.5% to 3.5%. People like guaranteed. The reason why they like guaranteed is because it's reliable, it's safe, they can count on it accruing at that interest rate for the life of the policy, and it lasts their entire life. Now, with the term infinite banking concept, the reason why that term's so popular right now is because over time, if you give these policies enough time to accumulate enough value, you can borrow against it, leverage it, invest in businesses, real estate, any type of entrepreneurial endeavor you'd like to look at. Or even kids' college, or buying a car for a kid, because when you go to borrow against these policies, you can borrow against them for the same exact rate that they're accruing interest at. So essentially, it's a wash if those policies are in place for long enough. Now, one cool part that I like to look at in terms of like whole life insurance as well is there's software out there now that, let's say you're $10,000 in debt. You can put in everything that you're in debt with, your credit cards, your car, your mortgage, whatever debt that you have, log it into your whole life policy, and it will tell you exactly how large of a whole life policy you need and how many years the policy itself can actually pay off your debt. Wow. Okay? And then after that, everything is essentially profitable when you get all your debt paid off. So that's really cool too, that there's software now in 2024, 2025 to be able to take care of that for you and show you everything in such an easy way to read it. And honestly, any family in debt that doesn't have a safe and reliable whole life policy is cutting themselves short. Now, another type of policy that people should look into, depending on their situation, is an indexed universal life insurance policy. Now, Adrian, we've already went over what whole life is. Index universal life insurance policies, you could say, have some similar characteristics, but what mainly separates them?
Very similar. I know he had just explained that a regular whole life is going to give you that guaranteed interest, whereas with an IUL it can fluctuate usually anywhere between 4 to 10% depending on the market, volatility, and what index that money is following, right? So remember, your funds are always going to be protected. It's only going to track it in a gain, never going to be a retrogress. So your funds are going to be compounding year after year. The main difference is, yes, you will receive more interest, but more importantly is that you can tailor these policies a particular way where more of your investment is going towards cash value accumulation and less towards death benefit, really giving you that extra compounding effect. This way, if you ever need some funds in the future, maybe you're facing any type of financial hardship, you'll have this liquidity that you can tap into.
But here's the cool thing about these policies, guys. You have to understand, it's higher risk, higher reward, right? With whole life insurance policies, you can get that guaranteed 3 to 4% with most policies. With index universal life insurance policies, some of these have cap rates of 10, even 12%, but they have a floor of 0% in terms of whole life having 3 to 4% guaranteed. So it's a non-guaranteed way, but if you look at the historical rate of the market, it always climbs up. So if you're in this for the long run, IULs over time will surpass any whole life policy that we've seen based on historical rates that we can show you proof of with some of these A+ rated carriers that you want to do business with. Not these fly-by-night carriers that lie about the rates on their illustrations and don't have any historical rates because they haven't even been around long enough to show you the history in some of these policies. So it's important to do business with the right carriers. I would also say that, and let's be honest here and transparent, in these policies, these IUL policies, there is a cost of insurance. I mean, it's life insurance. It has a death benefit attached to it, and you have to pay the insurance companies to have these actuaries follow the S&P 500 and make sure your money is safe when the market starts going down, because they're the ones that go in and protect it and keep it level whenever the market's at a downturn and keep it going up whenever the market starts to increase again. Now, let's say the market is in a downturn and your cash value stays the same. What happens is the cost of insurance and the fees within the policy might eat out of the cash value, but not the S&P 500 going down will it make your cash value go down. It's the cost of keeping your insurance policy going, keeping that death benefit alive. Now, people are like, oh, fees, this and that. The fees are so minuscule to the benefits that these have over time, where they supersede any fees that are associated with the policy. I'm just the one here with Adrian that's going to be transparent with you and tell you how these policies actually work. And if you have a 401k, guess what? They have fees as well. Over time, when you start paying into a 401k, you start paying at the tax bracket that you're in at that time. When you go to retire and take out your 401k, you pay taxes at the tax bracket that you're in at that time. So just understand, if your tax bracket increased because your income increased and you're in a different level at that time, you have to think about fees, you have to think about taxes, you have to think that you can't leverage against a 401k. So there are a lot of benefits to these IULs, but just understand that realistically there are costs of insurance and fees. Now, some policies have a lot less fees and a lot less cost of insurance than others. That's why it's important to be with A+ rated carriers. Once again, carriers that have been in the game for longer than 100 years.